Hey everybody, welcome to today's game plan. We are here. It is just a little bit after 9 a.m. I know we had a technical difficulty with the live stream, but I'm going to record this. You guys are going to have this in 10 minutes for you, so you're all up to date on the action. So first off, it's Friday, 9 a.m. Check out what we got here. I'm going to see if I want to keep it or not. We'll find out throughout the stream. All right, first and foremost, yesterday we had the CPI data coming out. Now the CPI data, Consumer Price Index, came in slightly better than expected. Ever so slightly. I want to jump over to this screen right here. Yesterday, the S&P 500 opened higher on that better than expected CPI data. It rallied up. This is the 10-minute chart. So each of these candles is 10 minutes long. We saw a beautiful move to the upside, but then look at what happened the rest of the day. The markets collapsed back down. When I see price action, when you see good news, and the markets initially react well and then roll over, that's actually a bearish sign. It means that even with good news, there's institutional sellers that are pounding down the market. All right, so that's important to recognize. That was bearish. I even posted on Twitter yesterday that that is not a good sign. It's bearish to see gains, especially on a low volume-ish type afternoon, get wiped out with the market selling. Okay, so let's go back here. Let's talk about the PPI data. The PPI data came in this morning. That's Producer Price Index. And the Producer Price Index basically means it's on the producer side. All right, that's the inflation. So consumer, that's what you and I are paying at the store, the consumer, the CPI. The producer is what the people that are producing the goods are seeing with inflation. Well, guess what? The CPI today came out slightly hotter than expected. All right, month over month, 0.3% versus estimates at 0.2%. Year over year was also 1/10 hotter than expectations. What does this mean? Well, to break it down simply, it means that on the producer side, inflation is starting to uptick. And we can jump over here, folks. You can take a look at what this says over here. All right, you can see the headline here on Market Watch. PPI shows sharpest rise since January in U.S. headline wholesale prices. All right, U.S. wholesale prices pick up in July, PPI shows. All right, now just to explain what this is telling us, this is telling you exactly what I've been predicting now for the last 6+ months, that inflation is going to get sticky above 2%. Right around 3%. That is your bogey level right now. So my guess is we're going to hover around 3% for the next 6 months, let's say, and that's going to make it very hard for the Federal Reserve to ultimately cut interest rates and print money. And why? You might say, well, who cares about that? The economy's strong. Well, sure, the economy right now is strong, but if inflation remains at 3% or greater, what happens when we do hit a recession? Whether it's in 3 months, 6 months, a year, 5 years, what happens if that inflation is higher? The Fed is going to be handcuffed. And that is going to put this economy in a tricky spot, especially the stock market, that valuations are absolutely insane. Speaking of which, I wanted to show you guys this chart. This is a chart of the NASDAQ composite. And the reason I'm bringing this up, and this might be a little hard to see, but we're going to try to show it here. So this is the chart of the NASDAQ and the .com, the run up, the pullback, and I showed this kind of a couple days ago. But look at that run up, look at the pullback, and look at the big bounce, almost back to the highs on the NASDAQ. Now, if we go back here, right, we slide this chart over here, it's very similar. Sharp run up, pullback, almost back to the highs. And then again, the idea here is that I think we're going to start rolling over and coming back in. And by the way, nothing goes in a straight line. So you shouldn't expect the markets to ultimately go straight down. I don't think we're going to go back to the October lows anytime soon. But I do think now you're going to stair step down, small bounce, down, small bounce, and eventually test that level. And you can already see it, right? We know Apple's earnings came out. They were a little bit on the disappointing side here. So if we bring up that daily chart on Apple, we can already see that we've broken some key support levels here. Here was a beautiful upsloping trend line. Look at the waterfall down. You've now started to consolidate here, which means you're likely going lower on Apple. So Apple, the biggest market cap company in the world, basically, $3 trillion, has now broken its upward trend line, which, by the way, goes back to the January lows on Apple. So that is a big break. Now, you'll have little spots of support along the way. That's normal, all right? You generally have that. But you have to understand that when these big Magnificent Sevens start to break lower, it is not a good scenario when they've been the ones to carry this market up. and now we're starting to see them coming down. Microsoft, here's Microsoft's chart, right? So Microsoft from 2023 start, major incline. In fact, Microsoft was $220 at the start of the year. It got to $370. It's now back to $320 in the pre-market here. So we are seeing these stocks come in. It's very hard to lift the market when you have trillion, $2 trillion, $3 trillion companies that are now starting to roll over. So I continue to be on the case, and I've been consistent. If there's one thing it's been consistent that you will see inflation stay around 3% and the economy is going to start to have trouble. And we are seeing the lag effect of monetary policy, which is 6 to 12 months lag, starting to take more and more a bite out of the markets. In addition, we'll talk about the dollar yen. The dollar yen is now in a precarious spot because of the yield curve control loosening that the Japanese central bank is doing. And there's lots of issues. But let's jump over here, guys. All right, so a couple other charts we want to go over here. And we're going to go over some other things. But right now, again, the markets are lower in the pre-market because of the PPI data. I think ultimately we could see a flush today following what I said about yesterday's price action was very, very bearish. But look at this chart. This is a chart I posted on Twitter, by the way. Look at the channel we were in on Nvidia. Okay, and I said if you break 450, you're going to see a flush through it. All right, we basically broke that, and look at the new channel. There's a channel down here. So you had a channel. Then that are parallel lines. Then you got in a new channel with the gap up on earnings. Now we've broken that one, and we're now likely going back to this level, which is going to be just sub 400, right around 400. So Nvidia should continue down. It is trading down $3 to $4. I think might even be down $5 pre-market. But expect us to head down towards that $400 level, which is an amazing trend line right through here. So that's your short-term target on that. All right, well, I do want to go to a couple key charts here. We have to keep an eye on the 10-year yield. Now, the 10-year yield to most people is super, super boring, but honestly, it's having a bigger and bigger impact on the overall market. All right, so what we see here, and this is a chart we went over yesterday, we have the downsloping trend line right here. We broke out, we retraced to the scene of the crime, we popped, we had that little pullback, now we're starting to climb. All right, we're now in the motion. We've broken out, so the breakout's already happened. This is just checkbacks now. You have kind of this stair step up that you're going to do, and essentially what you're going to do here, if we draw some trend lines in here, see this line to this line and how it connects perfectly right there. So that is your short term. Pivot high, pivot high, pivot high. Notice it's in a perfect line. That means you're likely headed up to this level, which is around 4.3%. Now, interestingly enough, if we look at this level here, what is that at? 4.3%, give or take. That means that you'll be at a double top at the same level. This was the highest yield back in October of 2022. Now, the reason this is important, folks, is because this is when the markets were at those October lows. So this is where the 10-year is. So if you look at a market in terms of disparities, you would say, okay, well, if the yield goes up here, could the markets go back to October lows? Now, not everything is perfectly the same. We know that, right? We know the Fed was in a hiking cycle. We know there were other issues there. But in the very least, could the market sell off more if we go back to these levels? And the answer is yes. The other thing I want to show you guys, the US dollar, Japanese yen. We'll get into a bunch of charts here. But basically, if we go to this chart on the yen, the dollar yen, we can clearly see that in October, the yen was up here, or the dollar yen was up here. All right, so huge move up. In October, the markets bottomed. It coincided with yields coming down and the dollar yen starting to come down. Well, now we've been same thing, starting to move up on the dollar yen. And what we can see here is that on a technical basis, we're now hitting resistance. But if this breaks, if this pivot high breaks through, you're likely going back to this level up here. So again, watch for that. Now we know again the Japanese central bank has said, hey, we got to loosen yields because inflation is now running rampant. The cost of rice or the price of rice is starting to skyrocket. That's a major impactor on their food side of inflation. And again, we're seeing that inflation bubble up. And I've said this before, but when you have 250% debt to GDP, you're not in good shape for having higher yields. Think about the amount of interest payments if interest rates really pop. It's bad enough the U.S. is now paying basically $1 trillion a year. We only have in the U.S. about 130% debt to GDP, which, by the way, I say only like it's acceptable. It's ridiculous, all right? Absolutely ridiculous to carry that type of debt to GDP, but that's what we have. All right, so that's something to watch here. Now let's take a look at a couple of the charts here. So I wanted to go over, let's go over the gold chart real quick, because gold initially this morning was up, but what we're seeing is gold struggling again. So this is a little bit of consolidation. The big factor for me is this pivot low here, this trend line. That's the key trend line, which is right around 1880. I do think gold's going to turn up in a strong manner here, but part of the reason why gold has been struggling is because we are seeing the dollar continue to stay strong. Remember, the dollar is still the best currency on a bad block. Doesn't matter how much debt the US has. Right now de-dollarization isn't a big thing. It could be starting, but it's not an impactful factor when people get scared. They still run back to king dollar. And what we can see here is the dollar's up again today, just like yesterday, and that's making it very hard for gold to really rally unless there's major fear in the market. Now, you could say there is major fear. No, there's not. There's not. And the reason you know there's not major fear in the market is because if you go to the VIX, which is the fear index, okay, here's the VIX. Let's zoom out. Okay, and I have a trend line on this here from a while back, but let me remove that right now. But basically, if we look at the VIX, you can clearly see this is no fear down here. Then you had, by the way, this is COVID, the spike in fear. This is the 2018 stock market collapse in 6 weeks that took place here. And look at where we are. We're basically in no fear zone. And so again, while I'm enlightening you and kind of putting you ahead of the curve in terms of being ready for what could be coming and alerting you to a 3% longer term, inflation number where the interest rates are probably going to be higher for longer, like the Fed has said, there's still the average investor is oblivious. The average investor is buying the dip, and that's telling us this as well. You've seen a little uptick recently, not enough to get anything exciting. All right, so what you're looking for is when you see fear, you want to see a 30 handle or greater on the VIX. Now, the VIX is a fantastic contrarian indicator. Contrarian indicators are one of the most important things in investing. Most people ignore them, but again, a contrarian indicator would be said the same thing as what I was alerting when Bitcoin was at 69,000, right? The amount of bullishness up here, I was alone on an island. You know, when I was bearish here, trust me, the ridicule, the craziness, the tweets, everything, that's when you want it to be bearish. When you see everyone else bullish, go the opposite way. Right? When everyone's, and think about this, good example of this. The start of the year, you turned on any financial news and they said, the first half of 2023 is going to be horrible. It's going to be absolutely horrible. Instead, what was it? It was amazing. The first half of 2023 was amazing. So you have to always think about it in a contrarian terms, and then you always come to the charts to confirm, and that's where the charts come in handy. But ultimately, when it comes back to it, the VIX is a great way. When the VIX is low, you want to be more careful, even though you're going to see all your buddies and all your friends going crazy and buying the market. You want to be more on the cautious side. You want to say, wait a minute, the VIX is telling me there's no fear. When no one thinks anything could happen, that's when things happen. Think about this. The VIX was at 13 or so, and I don't have the VIX up anymore, but it was at the lows, the 52-week lows, and out of the blue, we had Fitch downgrade the U.S. debt, Moody's downgrade banks, the Japanese central bank beginning to loosen the yield curve control. All of these things are starting, and now we're starting to see inflation starting to uptick, all when no one was expecting anything. That's a recipe for disaster for a market. All right, and that's when, again, you need to be more cautious versus being greedy. Greed is not good. Contrary to a great movie, Wall Street, with Michael Douglas and so forth, Charlie Sheen, but ultimately greed can get you in trouble. And that's the key. When people are greedy, you be fearful. When people are fearful, you be greedy. All right, so that's where we are right now, folks. I do want to cover one more thing in this stream, and this is another thing that has to do with greed, and I just want it to be educational for you guys. So let's jump over here. Now, this is the point. Recently, we've seen meme stock type moves on companies that literally have filed for bankruptcy. Okay, so let's understand this. This is going to be a great educational piece. So we saw Yellow Roadway, which is a trucking stock. It's a transportation stock. It went from essentially 50 cents to $5. Incredible move. But the thing is, there was people, and these were retail investors, they were chasing it all the way up. There was even a buyer right at that absolute high. That has to happen, right? There has to be a buyer and seller exchanging shares at $5 on this. Now you have to think logically, right? So this is where greed takes over and people don't think. They get emotional. They say, "Oh my gosh, look at this thing running. I'm going to chase it. I'm going to make money because I can sell it to someone else." And oftentimes you can, but the problem is you have to also be logical. And it really comes down to your investment thesis. Are you a gambler or are you an investor? Because if you're an investor, you take high reward, low risk scenarios and let them play out. That's what we talked about in, I think it was yesterday's stream, where you want to be the casino, not the gambler. The gambler may win on occasion, but the gambler, if they gamble enough, they lose. The casino over time always wins. And so you have to understand that this company literally filed for bankruptcy. And that means if you go to their balance sheet and you look at the amount of debt that they have, remember, debt holders, bond holders get paid out before shareholders. So basically, if you looked at this, you would see that there literally will be absolutely zero money going to shareholders. So basically, anyone that holds onto this stock will lose 100% of their money. Okay? So again, it's the greater fool theory. Yeah, sure, you could buy here and sell it up here to some other idiot. But ultimately, you have to understand that if you look at what a bankruptcy is and the assets that the company has, the shareholders will get zero. It's just the way it is. And we saw this yesterday with WeWork. WeWork basically comes out and says, hey, we possibly will be going out of business. What happens to the stock? It runs up astronomically. Basically, I think at one point it was up like 150% on the back of that news. All right, again, look at that run to the upside. Incredible run from the previous day close of what, 12, 13 cents? It goes to 30 cents. Incredible 200% run. All right, same thing here. Yeah, great to kind of just trade it and be in and be out if you're lucky, but you got to understand that if they file for bankruptcy, you got to look at their balance sheet and you got to see what are their assets and then ultimately how much debt do they hold, because the debt holders, the bond holders, get paid out first. These are important lessons, and I'm going to tell you this, guys. I learned this the hard way. I was the person buying stuff. I was the person buying, again, it wasn't Bitcoin because at that point in my career I've learned, but back in 99, 2000, 2001, 2002, 2003, 2004, and I'm dating myself for sure, but trading for 20, 25 years, you go back to my first 5 years of trading, I did everything wrong. And I'm here to tell you that it's okay to make mistakes. You have to learn from them. And again, I eventually learned. I think I made mistakes more than I should have, and I wish I didn't, because I'd be a lot wealthier than I am today if I didn't make so many mistakes or bet as much money. But the point is, you just have to learn. Just keep on absorbing and learning from mistakes. A trading journal is amazing. Every night, review, write down which were your trades. What did you do right? What did you do wrong? What were the factors? What was your thesis for getting in a trade? If you're like, wait a minute, my thesis, I didn't have a thesis. Well, you probably shouldn't take in that trade. And you have to really, if you want to be a pro, and I don't care if you're a day trader, swing trader, or investor, you still need a thesis. You need a thesis where, imagine you're standing in front of me right out here, and you're saying, hey, I have a stock, and I want to pitch it to you, and these are my factors for wanting to get in. If I tell you that's BS, then you have to understand that that's probably not a good thesis. So think about it like that. You want to make sure that you have the factors in alignment. Again, it comes down to money. Do you want to be rich? Do you want to lose all your money and be poor? Make that decision. Learn from your mistakes. Again, trade smart and just continue to educate yourself. All right. I got to get going. The market's going to open real soon here, guys. But I just wanted to say thank you for making this one of the most popular new shows out there. Tell your friends, guys. I will continue to delve into things that you're not going to hear anywhere else. Give you chart setups, give you day trade, swing trade, ideas, everything I can to make sure that you can learn as much as you can to become as profitable as you can. Thank you again, guys, and take care.